Hi, this is Robin. I'm going to take you through an example of eliminating unrealised profit on inventory sales. So IFRS 10 gives us some guidance here, not overly helpful. It doesn't help us with journal entries, but it's telling us to eliminate in full intragroup transactions that may lead to profits or losses resulting from those transactions that are recognised in assets such as inventory. So paragraph B86 gives us some guidance but doesn't tell us how to do it. It also mentions there that we need to think about temporary differences. So we need to look at transactions that occur within the economic entity, and where that happens we need to eliminate them. So here you can see in this picture that the subsidiary is having a transaction with an external party. So that's all good. We recognise that transaction in the consolidated financial statements because it's happening with an external party. They're paying $50 for inventory. But if the sub then goes to sell it to the parent for $70, then we're not going to recognise that internal transaction that occurs within the economic entity. So the parent now has inventory for $70 and the sub's saying that there's a profit. So that internal transaction needs to be eliminated. Let's have a look at an example and I'll take you through some entries. So I've got a parent that controls 100% of Surrey, so that's Preston in charge. During the year ended 30 June X5, Surrey, the sub, sold inventory to Preston. The selling price was $70,000 and the selling prices from Surrey to Preston are based on cost plus 40%. Preston has all the inventory still on hand when we're doing the consolidated financial statements at 30 June 20X5. And in the following year, X6, the inventory is sold by Preston to an external customer for $80,000. The tax rate is 30%. So let's have a look, for starters, what's happening in Surrey's general ledger at 30 June 20X5. First, we need to calculate what the actual profit is on the sale if it's based on cost plus 40%. So if the selling price is $70,000, it means that the cost was $50,000 to Surrey. Therefore, there's a $20,000 profit. In their general ledger, they would have recognised entries on the date of the transaction like this. So debit cost of sales 50, credit their inventory, recording some cash and crediting sales revenue. Let's start looking at the consolidation entries. So that internal sort of transaction between the group was for sales of $70,000. So we need to debit our sales revenue and credit the cost of sales by $70,000. So notice how in this entry, both these transactions go to P&L. So overall, I haven't yet altered the group profit. Okay, now let's work out the unrealised profit in the closing inventory. We worked it out to be $20,000. So what I'm going to do is firstly, I'm going to credit my inventory because I'm lowering it from the $70,000 down to what the cost was to the group, the external cost of $50,000. And I'm going to match that by debiting cost of sales. And that's how I'm eliminating the unrealised profit because I'm putting a debit through to my P&L of $20,000. I'm going to drop my income tax expense by $6,000 to match that reduction in profit of $20,000. So 30% of the 20 grand, I'm going to credit income tax expense. So a handy rule: when you alter consolidated profit, then make a tax effect adjustment. And I'm going to debit a deferred tax asset. So I like to think that the tax is being paid by the sub at an individual company level, but this happens before the group is able to recognise that $20,000 profit. So therefore, the other side to my tax effect entry is a debit to a deferred tax asset. It's like a prepayment of tax. So notice how now, after these two consolidation entries, I've dropped the group's cost of sales down from the $70,000 down to 50,000 now that I've put that debit through to cost of sales. So refer back to that previous slide for that entry where I credited cost of sales for 70,000 when I did the elimination of sales and purchases. Now let's take it through to the next year, in the year ended 30 June X6, when Preston makes the sale to the external party. So remember, they're selling it to a customer for $80,000. So they're going to record in their general ledger these entries whenever that transaction occurs, and they'll recognise a $10,000 profit. So they're debiting cash, crediting sales revenue for $80,000, and recording the cost of sales based on their cost of $70,000 and crediting inventory. But remember that the cost of the inventory to the group was $50,000. But at the moment, what's coming through from Preston's general ledger is cost of sales of $70,000. So we're going to have to do something on consolidation. Now remember that consolidation journal entries have to be made each year. They don't alter the general ledger. So therefore, they're notional entries that don't carry forward. So the fact that we made some entries back in the X5 year on consolidation, they're not going to carry through. So we need to make some adjustments in X6 because we've now got unrealised profit in our opening inventory that we have to deal with when we're doing the year ended 30 June 20X6 consolidated financial statements. So in the 20X5 consolidated financial statements, we reduced the profit after tax by $14,000. That was the $20,000 debit to cost of sales and the $6,000 credit to income tax expense. So therefore, we have to reduce our opening retained earnings by $14,000 to reflect the fact that last year on consolidation, we dropped profit by $14,000. So now I want to credit my cost of sales by $20,000. I'm upping the profit because I want to lift it up by $20,000 to make sure that I'm getting the correct profit coming through. I'm upping my profit by $20,000, so I'm going to match it by recognising income tax expense of $6,000. So now the group's sales revenue is correct at $80,000. That's coming through from the general ledger of Preston. And now the group's cost of sales has been reduced from $70,000 coming through from Preston's general ledger down to $50,000 because of this $20,000 credit entry. So on consolidation, we're realising the $20,000 profit as this is being added on to the $10,000 that's coming through from Preston's general ledger. Now there's no need in this entry to make a credit to the DTA because I only recognise that last year on consolidation and that doesn't carry forward. Okay, finally, let's sort of think about what happens if we didn't have a wholly owned sub. What if it was a partly owned sub? When do I need to make an adjustment for the NCI when there are unrealised profit on inventory sales? We can have what we call downstream sales. So the parent is the seller and the sub is the purchaser. So that's when the unrealised profit is sitting in the parent's books. On the other hand, when you've got upstream sales, the sub is the seller, they're the ones making the profit, and the parent is the purchaser. So it's when you've got an upstream sale that you adjust the non-controlling interest. So don't adjust the NCI when you've got downstream sales. I hope that clarifies things around unrealised profits in inventory.